Okay, I want to welcome everybody to today's webinar with our special guest, Chris Blasi, on real estate and precious metals synergies in the age of coronavirus. We'll start off briefly. I'll go over a few things. My name is William Mucker. I'm a client executive at Camaplan. We'll go over a brief disclosure statement, and then I'll pass the reins over to Chris after I give him a quick introduction. So again, I want to welcome all Camaplan clients, registrants, and people from the future who may be watching the recording of this on YouTube or camaplan.com. And without further ado, I'll start off with our disclosure statement. So this basically was put together by a clever attorney somewhere to let you guys know that we at Camaplan, we're not attorneys, we're not licensed to give any tax advice or legal advice. We don't give any endorsements or recommendations, but we do encourage you guys to do your own due diligence, whether it be investing with your qualified funds or with your personal funds. And the experience with Camaplan is hyper-personalized, so although we may not be able to give that advice, we do encourage you to bring in your financial team, and whether it be a conference call or an email thread, and we'll make sure that we cater your experience and your investment directly to their advice. I just want to put my contact information here real quick. My email address is wmucker@camaplan.com, and you can reach us at 215-283-2868. If you want to call or email me, you don't have an account, and you would like your $50 application fee waived, we'll be more than happy to do that to all registrants at today's webinar. Also, if you have any friends or family that may be interested, even if you're a current client, whether it be nieces and nephews that you want to help open up a Roth IRA and get them started on earning tax-free income for life. I wish my parents had did that. I probably wouldn't be here today. Just email me or give us a call, ask for Will or one of our other representatives, and just mention that you were on today's webinar with Chris Blasi, and we'll be happy to help you. And without further ado, I'll give a brief introduction for Chris. Chris is a veteran in the financial and technology industries. He has over 30 years of experience. He's also the owner of the patented PMC ounce, which is a precious metals composite. Chris has taken his expertise and professionalism to a number of different publications where he has contributed his intelligence and intellect to things like the Wall Street Journal, Investors Business Daily, MarketWatch, TheStreet.com, USA Today, CNBC. And he also has his own podcast, Great Reset Opportunity Report, and it's a regularly released series. And without further ado, I'm going to hand this over to you, Chris, and you can begin your presentation.
Great, William. Thank you very much.
Of course.
Okay. Okay, can everyone hear me? I hope we're all, there we go. So thanks a lot for joining, everyone. My name is Chris Blasi, and we're going to be talking about, it's not really about the coronavirus, it's just what's happening in the economy right now. It's kind of being accelerated and exasperated by the coronavirus. So, but a lot of, actually, the trends that have been in place that are affecting the financial markets have been going on for some time. It's just that now we're seeing we're seeing much more of a dramatic effect by that. So before I jump into this, I just want to say I'm a precious metals dealer. We're not giving you advice. We're providing this information for you to, evaluate and, and factor into the decisions you make to invest and preserve your wealth. So again, we're talking today, we're calling it in the age of coronavirus or pandemic, because now so many breaks and chinks and problems within our financial systems are becoming more apparent. And the reason the focus today is on real estate and precious metals is because I'm fully aware that many people who work with self-directed IRA firms are real estate investors. It's usually what first brings them to these organizations. So we're like to present today what we see going on in real estate, which many of you who are real estate investors will be acutely aware, but maybe from a perspective where we're not as close to real estate. Because sometimes when you're very focused on a particular asset class, there's certain things that are not being considered. And we're going to show why a logically balanced position, which also factors in precious metals, for a real estate investor makes a lot of sense, and why there are particular synergies within such a balanced or such a configured portfolio. So now let's just start off what's really been going on. As we say, there's been issues going on, especially we'll obviously focus on the United States for some time. And that is, there has been a systematic liquidation or destruction of the middle class. This goes back to 2008 and prior, right? That's, and we're not going to go into the big picture, macro picture, but there's been issues with employment. Right now it's, hyper unemployment, but there was a lot of underemployment that was taking place in this economy for the last 20 years, right? As we deindustrialized, as we had a disparity between some very highly compensated people in a top tier and a lot of the middle income disappearing. And we're just going to touch on these because, as you know, as real estate investors, this is important to you. Also, there's been small business destruction. This has been going on for a long time also. Big businesses, either through regulation or government bailouts, have always been favored over the small business. Now, with this current pandemic, we are seeing that, it's at a level of destruction that is unheard of. And regardless of these little programs about, paycheck protection and such, small businesses are being decimated, and there is no program or really nothing to bail them out. We're going to talk about small landlords because most people, right, who are using IRAs for real estate would be classified as small landlords. And they're going to face some of the headwinds that any small business face, especially compared to the next category, the too big to fails. The too big to fails are those institutions that are constantly bailed out by the government, regardless of their incompetence or malfeasance, because they're deemed as systemically important, but that's really not correct. It's really this nonstop wealth transfer from the middle and upper middle class, either businesses or people, to that 1%. We're going to talk about helicopter money. This has been predicted for 10 plus years by some very astute observers, and it's happening right now. They're not calling it helicopter money, of course, but this is called unemployment with a $600 accelerator added to standard unemployment, ways of just pumping money into the system, hoping somehow it revives an economy. But that's really not a long-term fix or even an intermediate fix. Universal basic income, this is our road down toward pure socialism. That is the natural next step for what's happening during this pandemic with the massive unemployment, small business destruction, and helicopter money. And then, as I said, the destruction or the attack on the middle class and the small business has been going on for some time. In 2018, it happened, and the reaction by the government to bailing out the too big to fail at the expense of everyone else. Right now, this pandemic is accelerating it. And, and these money transfers, these wealth transfers from the small and middle person to the big, this is manifest through stock buybacks and other wealth transfer schemes that take place. Now, I don't think it can really be argued anymore that the old playbooks work, that we don't have a truly monumental change happening right now. If I said 20 years ago or 10 years ago or even 5 years ago, what's taking place now would happen, very few people would agree with it. So because of that, there is a natural instinct for most people. It's called a normalcy bias. And a normalcy bias means people view everything going forward as just a continuation of what happened in the last 5, 10, 20 years, or even their lifetimes, and that they do not accept the fact that there can be a total change, that an industry can disappear, that a investing strategy should be altered or is no longer effective. That's called normalcy bias. That's what damages or hurts most individual investors, because they keep running the same playbook and will not accept that there's change. And that will happen now. And that's what we're kind of want to talk about today, to kind of maybe evaluate things differently and not let our, and get past, some of the normalcy biases that may affect us. So we are not in a typical environment, right? We are right now in the deflationary stage. Now, there is inflation in certain minor categories, but overall, we have deflation going on, which is why the Federal Reserve and the Treasury are trying to pump money in the system. So let's just talk about real estate right now. Especially, we'll say the first one is commercial real estate, or, in retail space. Now, I understand a lot of people say, well, I'm not involved in that. I'm in residential. But you cannot escape, because as an economy implodes or readjusts itself, right? If commercial goes down, that means business is going down and things are changing, so everyone gets affected. So all these factors need to be considered. So right now we have falling prices. When I said the coronavirus just has exacerbated things, if you take major markets like New York City's retail and commercial space has been going down for a number of years. I personally know individuals who own restaurants in New York City, completely wiped out, they're done, not paying their lease anymore, going to court because they've been forced to close their business by the government, and therefore they feel that they shouldn't pay. These are the types of things that are happening. This means falling prices for commercial property, for retail property. That means debt defaults, that means bankruptcies, that means continued wages, layoffs and reduced wages, and overall falling demand. So as the restaurants are closed, the food service distributors are closing. This is a deflationary cycle. Things are actually, and that will accelerate for a while. And that's an important thing, because as things are deflating, is that a good time to buy them? Obviously not. Some people will say it is, but there's also the term, you're trying to catch a falling knife. So I think we are personally, and I'm not an expert in real estate, but just from logic that applies to any investment, when you're in this stage, it is very dangerous to feel that you can, the bottom, because you may think you have a bargain now, but that piece of property or that asset will be 10, 20% cheaper in the not too distant future. As a matter of fact, the debt defaults and the bankruptcies, it is just starting to happen now. So I think for an investor in certain assets, including real estate, this would be too early to basically take your capital and apply it. Unless, of course, there is always extraordinary circumstances or situations, but we're talking about overall. So in this environment we are now in, right, where we have pandemic, we have government shutting down businesses, which was never happened before. Even in other pandemics of 1918, there was always the belief that it is up to the owner, the individual, to make that decision. So we are in a different time. So now going forward, I believe you really need to rethink and reconsider what it means to preserve wealth and how you do it. It also means the playbook you are going to use as an investor, whether it's in the fixed income, the equity, the real estate, or precious metals, you need to review that. You need to approach risk in a whole different way. People have discounted risk. There will be times when the bailing out will not be enough, and therefore what people thought would be a backstop will disappear. And we're going to talk about that a little more. And I believe investors need to consider what they previously would not accept as with the reality, or even what investment strategies need to be. Again, because you don't want to be using yesterday's playbook. It doesn't mean a major asset class like real estate isn't going to be viable going forward, but it could be dramatically different. And it could have different risk levels that never were there before. And that needs to be factored in. And that means, right, pricing differences, right, to account for that risk. I believe going forward, liquidity is going to be more important than ever as far as it comes to investments, and portability. And of course, all of this means how do you position yourself for the future to thrive and survive. So again, looking at real estate, what are some of the macro trends that have kind of been happening, been in place, but are now being exacerbated and coming to the forefront under our current conditions? And that is location is one, right? I mean, I know the old adage, location, location, location. But you are now seeing, up until not too long ago, like I'll use the New York City area where I have a better understanding. You had these outer boroughs that were hot, right, trendy, and people were paying astronomical amount of money for space in those communities. Well, now people are starting to flee New York City. And that's being exacerbated by what's happening right now. So, again, these trends are changing, right? Rental properties are going to be impacted by what's happening, by the mass unemployment that's going on, the amount of underemployment that's going on, and also something we're going to address, how the government is kind of making rules by the seat of their pants that directly affect landlords and renters. And of course, most of it is to the landlord's detriment in this current environment. When it comes to retail, commercial space, especially office space, companies are now realizing, since they've had workers who never work remotely for the last couple months, that, you know what, we can do this and we can save a lot of money by having more people work remotely or maybe share space. So this is a trend that was happening, but then when you have an event like this pandemic, it just goes into hyperdrive. Changes in preference. There is in the New York City area, just in the last month, there's now a big shift out of the city into the surrounding suburbs. But that means everyone's kind of pushing out a little. Household unit formations are different. I know a thing that you'll hear about, especially with commercial property. They're talking about repurpose and redevelopment of existing stock. That's doable, but that's easier said than done, and that's a risky thing unless you're a big time player. And I'll give you an example. The malls of the world are virtually all losing money. There are very few malls. There was a couple, one in Beverly Hills and one in Short Hills, New Jersey, that were the prime mall properties in the whole country, and even they are now just experiencing trouble. So yeah, I use this because this is a very good example of an extreme case. People talk about, okay, well, in the future we'll repurpose malls, right? How really, malls are very specific built. You could just know the configuration does not lend themselves to much. And we don't need more retail space. We'll look at that in a little bit. So my point, I use that as an example, is yes, there's going to be a lot of things put out there and people will create funds saying, let's pool our money and we'll buy and repurpose commercial property. My point is, it's going to be easier said than done. It may be too early to jump into things like that. So therefore, maybe you need to look at how are you going to invest and preserve your wealth during this interim period. Again, opportunities and threats in the world of real estate. We got changing modes of mobility, right? Now things are using the internet more. Remote work is becoming more and more accepted. Demographics, of course, are a threat. I know a lot of folks on this phone are around the Philadelphia area, so they know the nuances of Philadelphia better than I. But both Philadelphia, New York, and other major metros share a lot of the same situations just by the fact that they're highly urbanized environments with large lower middle class populations and a lot of high costs and regulations. And I think now regulations, as a good example, especially by state, local government, is going to become more of an impediment for success as a real estate investor. And therefore, again, we're going to talk about the synergies, why things like precious metals don't have those same things, and why it's a nice balance in a portfolio. Of course, real estate affordability is going to be changing going forward. There's wage stagnation. There's a lot of employment that will not come back, and that, of course, affects affordability. And with changing tastes, demographics, and now maybe with what we're seeing going on in the streets in some cities, that there is going to be a movement away from some of those urban centers. and what gets left behind will not be the best and most viable renters. And then, of course, government is getting more involved in intervention and assistance. That is problematic because it takes away a lot of the free market benefits. And anytime they have assistance and they assist, that means it comes with a lot of strings attached. So these are things that we need to keep our eyes on, especially in something like real estate that is so personal and important to the population. Again, I'm just going to look a little bit on like retail as an example. Of course, this is not the same for residential, but it all trickles downhill. You can't have certain industries getting decimated because that means people lose their jobs, people lose investment money, and that trickles down. So we talked about repurposing property, right? Retail, we have way too much in the United States. I mean, I've wondered for years how you can walk into some of these big box stores, look at the size of the building, and see so few people shopping in them. I always wondered how they make money. But you can see here from all the developed economies of the world, how much retail space the U.S. has. So, you know, dramatically more than Canada, who's just second place. But you get into affluent countries like Japan and the European countries, and it's almost eight times. So we have a gross oversupply of retail. And therefore, even that whole, we'll just repurpose existing properties, I don't really see how retail is going to, you know, converting it to a different type of retail space is going to help. Again, it's just pointing out the challenges, right? So if, you know, funds who may pose themselves as or present themselves as vulture funds that are going to buy strip malls cheap, you want to ask yourself, but is the demand really there? I mean, have we found the bottom? How cheap is it? Is it really the cheapest price? So I submit that we are in the early stages of the acceleration of change that's taking place macroeconomically and culturally in this country, and that needs to be factored in. You know, all investments, regardless of like when you see a bubble in the stock market that seems to defy logic, at certain points, the fundamentals and the logic and the truth will catch up and prices will adjust accordingly. Now, one thing, most investments have what they call counterparty risk. And, you know, for so many years, real estate, you know, a lot of people felt that the risk was minimal. But when you have the government start to intervene, this is when a level of risk comes in that really needs to be considered and factored in. So here's just one snippet, you know, and this is what's happening in commercial real estate. So California, as some of you may know, has basically wants to change the rules, the laws to allow businesses to walk away from their commercial leases. You know, that means without recourse. This will change the economy dramatically. This is not a small thing because who owns most major commercial leases? These are insurance companies, right, or pensions. So all this trickles downhill. So, you know, they come out and they say, okay, you know, we're going to let you walk away. But who is that going to affect? It's going to affect the domino effect. It's going to be astronomical. So as you can see, there's these knee-jerk reactions to a situation, and the situation is bad. But we are such an integrated economy that so much is dependent on someone else. That's what counterparty risk is, right? There are people who say, look at my portfolio. I've got all these mortgages, right, like a commercial portfolio if you're an insurance company. But now you have states telling the renters, you don't have to pay your mortgage. You don't have to pay your lease. So this is what's starting to unfold. And if you're following the news and this quote-unquote socialist revolution going on, you can see the trend is toward more of this intervention, which is detrimental to the folks that are operating in a more entrepreneurial and free market system like real estate investors. And for those who think, you know, I don't need to be concerned, I'm in residential, there is, as you know, there are cities and states who are also looking to make changes to the rules regarding rent, mortgages, evictions, foreclosure policies, and they're all doing it under the guise of the COVID-19 pandemic. Again, we were going down a socialist path before, and this event is being used to further that. So again, I believe most would agree that with a major capital investment like real estate, everything needs to be reevaluated, the risk, the pricing, and such. So why do we make the case, or do I make the case, that for those especially who would not or have not considered the precious metals, that I think they really need to reevaluate this? And I'll go back to, so who's behind the helicopter money, the bailouts? It's the central banks, right? They're the ones in control, right? They set the interest rates, they disperse money, they're the ones that ultimately bail out the too big to fails. And unfortunately, we're not in a free market system because they get to designate the winners and the losers. It's not fair, but it's a reality, and it's a reality a sober investor has to deal with. So why do I put up this headline? Now, this has been going on for years. That same central bank, or those central banks who are flooding the world with cheap money, and that's not just here in the US, but it's in Europe, it's all over. Well, they've been buying gold in an accelerated pace over the last few years. So, and it's not just, China, it's in Europe, it's in Central Asia, it's in Russia. What do they know that the average person isn't being told? As the average person is told by their mainstream financial advisor, oh, you don't need gold, that's a barbaric relic. Why would someone like the central banks be building their positions out? Now, this headline is from a year and a half ago, so things have not changed, because here's one that just came out a couple days ago. The World Gold Council tracks the central bank buying of gold around the world, and they're continuing to do it at an accelerated pace. Just in 1 month alone, in April, they bought another 32 tons. And if you look at the wording down below, net central bank purchases since the suspension of the convertibility of the U.S. dollar to gold in 1971 is higher than it's ever been. As a matter of fact, just last year, it was the second highest total on record. So why are the central banks buying? Now, unfortunately, with some people that jump into gold, they buy it, and if it's not up in 3 weeks, they're disappointed, right? That's the wrong way. This is everyone around the world is positioning for what's taking place. So my advice for someone who realizes I need a position in gold or silver, precious metals, this is for the intermediate to slightly longer term. You don't purchase it and feel disappointed if it doesn't go up 30% in price within a month. It is grinding higher. It'll go up a little bit each day and down a little bit. It's trending higher, but this is about wealth preservation for everything that is changing around us. So just to give you a picture, for anyone who's listened to me in the past would know that we have said way back in 2006, before this chart even made this picture right here, that gold is in the secular bull market from 2001. That will run about 25 years. It'll have 3 legs to it. We are in the third leg. The third leg is the biggest leg for upside potential, and we'll end up with a parabolic blow-off. So right now, for those who think, oh, it's a little too late, that is not the case, because we haven't even reached the highs of the first leg. And and the way secular bull markets work, again, that third leg will not only meet, but greatly exceed the highs of the realized at the end of the first leg. So again, for anyone who followed me through the years, knows that I put this chart up at every step of the way, even during leg 2. I said there will be you always have the second leg down after the first major move up, which is about a 50% retracement in the gain, which is exactly what the second leg was. And now we took off at the end of 2015, and we are in the third leg. Okay, so we talked about, you've always heard the term portfolio diversification. So this is why it's more important now than ever. And I'm going to talk about the synergies, right? So we all know, what is portfolio diversification? The point of it is to vary your assets, diversify them amongst more than one asset or two assets for the point of getting the best risk-adjusted return, okay? And that's what some people don't understand. Sometimes they go all in on something, right? I mean, that's like going to a casino and say, I'm putting it all on black. Problem is, if it comes up red, you're wiped out. Or I remember a person telling me years ago, I'm house rich and cash poor. Well, that's not a great strategy. It's good when the winds are at your back, but in the long term, that could be detrimental. So, and the reason diversification works is because different assets react differently to the same economic event. So the events we have right now, mass layoffs, destruction of small businesses, obviously not very good for a lot of real estate properties. And we could take it a step further. There's going to be changes in colleges because now online is going to become used more and more, online learning, not only because colleges have gotten so far ahead of themselves with way overpricing their deliverable that now no one has the money for it. That's going to affect, real estate, off-campus real estate. So when you talk about and you think about the domino effects of things, you really have to extrapolate out all the changes taking place and what's happening. Now, for the synergies, synergy just means, right, the combination of two things are better than and work better together than one on their own. So let's jump into why this is good, why precious metals have characteristics that are uniquely different than real estate, and why that makes for a perfect balance. Now, one thing they both share, they're both real assets, and that's a good thing, right? So they're both tangible, they're real. Now, we'll jump to the second characteristic, cash flow. This is what obviously been the thing that real estate investors have always seeked and has been the positive, and is why real estate has been an excellent and will continue to be, the right properties in the right situation, a good investment. Precious metals are not a cash flow. And there's a reason for that. It's not so much a negative, it's because that's what its characteristics. It has no counterparty risk, right? Where's counterparty risk, you may ask? Well, cash flow exists because you buy a property and you rent to someone. The risk is that the person renting the property doesn't pay or is unable to pay. But precious metals does not have that risk, but it doesn't have cash flow. So therefore, it's not that one asset is better than the other. It's just that they perform differently, behave differently, and that's actually a positive. So the next point that's important to this investment is it's divisible. Real estate isn't really divisible, right? I'll give you what that means. You buy a property, it costs $500,000. So it moves in one big unit of $500,000. Precious metals, $500,000 can be, a couple hundred ounces of gold, thousands of ounces of silver, and that becomes highly divisible, meaning you could buy 100 ounces of gold and sell it off 1 ounce at a clip, whether you just need a little bit of money, but you don't want to sell your whole investment, or the price is going up and you want to take some of your profits off the table. So as you would agree, or hopefully you see, real estate is not divisible. Precious metals are. There's the balance between the two, right? So if you have a position in precious metals and you need to raise cash, it's easier with that position than generally with your real estate. Portable. Okay, location, location, location. That's a good thing, but it can also be a bad thing. If that location happens to be in an unfavorable spot because of demographic changes or the local government becomes hostile, like they put rules in about eviction and treating renters, well, you have an unportable asset. It is there. Precious metals are completely portable. You can take them, you can ship them, you can store them in all different locations. You're outside that risk of local government or changes in demographics or preference for a local area. It's agnostic to that. Again, it just means that's where the benefit of the balance is. Having both gives you those flexibilities. So if you had both in your portfolio, you would have portability. You can have real estate, but you also have the portable, divisible asset, which is precious metal. Next is what we talked about a little bit earlier, counterparty risk. The reason precious metals don't have counterparty risk is when you buy the metals, and it's the actual metal and not an exchange-traded product, That's all it is. No one has to do anything for it to perform as precious metals. Now, the price goes up or down, but it's not dependent on someone on the other end, meaning anything that's fixed income, like a lease or even a bond, unless the person, right, who pays makes good on their payment, then that asset becomes worthless. All right, what value is it then if you can't collect the money? So therefore, again, this is a nice balance between the two. Next is liquidity, right? When you have to raise money, precious metals are completely liquid, right? Again, you could do it in small increments, and there's no delay. So a client of ours that has precious metals, if they needed to raise the money today, they would call, they'd sell. The price is obvious. It's all calibrated off published pricing. It's not negotiated. Those are advantages, right? You don't have those advantages in real estate. I mean, if you needed to liquefy your real estate immediately, you would have to give it away, right? We know that, right? But to get your what you would believe is a fair price, it's generally going to be in the market for a while. Now, lastly is carry costs, right? So if your renter is not paying, right, or is not able to absorb a higher rent and you're being burdened with higher taxes and such, if you have non-performing real estate, the carry cost is high. I put a little shade with precious metals. So if you store it in a depository where it's fully insured, there's a very, very minor carry cost, but there's a little bit there. Now, of course, if you had it in your possession in your house, it doesn't. But even the carry cost for the benefits of being fully insured at current market value is negligible. So that is a nice picture, I believe, of why you have a good balance between two assets. Precious metals, unlike most assets, really have this synergy, this perfect balance with real estate, more than almost any other asset, or maybe any asset anywhere. And of course, precious metals has a 5,000-year history. Stocks do not. I mean, stocks may be around, but companies come and go. Bonds, come and go, right? Companies fail. They go from a AA rating to junk, right? Precious metals are what they are. They have always been, and they've always been liquid. So therefore, I'm just submitting to you as a group that this is an important and valuable component to your portfolio. And if you are a precious metals investor, I believe that with the way things are unfolding, you probably maybe best bet to add to it. So, and I just want to show you one picture here. This just shows you that product that Neptune Global has had for so many years called the PMC ounce. That's shown here in the red line. This is its return since its inception. Below that, and you can see it's 134%. Gold below it is 102 and silver 70. And you may ask, why is the PMC ounce higher? Well, that's because it also has palladium, which really has greatly underperformed and at some point will start to contribute. But it also has, platinum. But it also has palladium, which isn't showing on this chart. And palladium has been a tremendous outperformer. So what we submit, if you're interested in the PMC ounce, what it does is not only is it a precious metal, but it's diversified within the precious metals. So it's basically synergy and diversification within an asset class that you would add to your portfolio for overall diversification and synergies. So I got a couple questions that were submitted ahead of time, and I believe we have a chat box. So you can submit questions, and I will just read what I have right now and I got. So again, if you have any questions, just please submit them. One question came in and I'll read it. Can you break down how to look at a percentage allocation to precious metals? Would you base it off of a net worth of all investments outside your personal residence? Simple example, if you had 1 million, great question, right? So yes, when you look at an allocation, just like you said, outside your personal residence, I see where you're coming from, and that's the correct way. I do not consider personal residence an investment, and I know that's when you're determining an accredited investor, you can no longer use personal residence as part of your net worth. So there's rules of thumb, right? How much? 10, 15, 20% in precious metals. I will not give that number. I would say a minimum of 10, but I would also say this. when you put something and you're balancing a portfolio, I would recommend that is at least significant enough so that if your other investments are going down, right, the ones that will behave differently during an event, that it will be enough to counter it. So the person with $1 million who says, I'm going to buy $25,000 in gold or silver or the PMC ounce, I would say, well, that's nice, but what is your risk profile on the other 95%? So, I think you get that, and that's my answer. So I'd say absolute minimum 10 to 15%, but look at your situation and make that determination. And just, everyone goes with the 10 to 15% because when people make recommendations, it's their, no one wants to be responsible and someone misconstrue an answer and go all in, because you don't go all in on precious metals either. So that would be my answer. Minimum 10 to 15%, but I know people have other allocations based on how they view risk and the situation at hand. Another question, how is the PMC ounce stored and how can I access the physical metal when requested? All right, so the PMC ounce is stored in a non-bank depository in Delaware. All the metal is fully allocated. The depository is tracking the ownership also. The PMC ounce does, now if it's in an IRA, of course it has to stay there, but the PMC ounce has what they call a convertibility option. You can convert to whatever specific bar or coin you want, and that's what would be delivered to you. You just have to pay what they call the premium, because things like Gold Eagles or Maple Leafs have a higher premium versus bars, and the pricing for the PMC ounce is really calibrated off big bar pricing. But that's a small upcharge. So the short answer is stored in a non-bank bullion depository. There is a conversion option. It's even on our website. And you would just then you would decide what item you want to convert to, and that's what it would be shipped, whether it's a 1 ounce bar, 10 ounce bar, or coin. Now, I would also just say if your intention is to buy the PMC ounce and immediately convert it for delivery, I would recommend just purchasing what you'd like and right from the get-go and have it shipped. But we have that convertibility option so that you have that peace of mind. Okay, what other questions?
Hey, Chris?
Yes.
Not to interrupt, you're doing a great job, and it was a great presentation so far, but due to some time restraints, is there any way we can maybe do about 2 or 3 more questions? Then you can give them your contact information, just in case, any questions
Sure.
weren't answered, so we can get off by about 1:50.
Okay. All right, I'll move quick. So here's a couple answers. Where do you think silver is going? Common question. A lot of people like silver because it's a low price point item. It generally always lags the price of gold. It is starting to perk up now. Do I believe gold will be a lot higher in the next several years? Yes. Do I believe silver will also move higher? Yes. And there is a good argument to be made that because silver has lagged gold, like it always does, when it does pick up, it is a more volatile metal, both to the upside and the downside, and that the return going forward may be higher on a percentage basis with silver. But so, that makes the case for having a balance between gold and silver. But again, the PMC ounce actually does it for you, and it also feeds in and adds a little bit of platinum and a little bit of palladium, which have been great contributors, which most investors have not been able to take advantage of because they've just been gold or silver. Here's one. Do you think the PMC ounce is still better going forward? Yes. Personally, it comprises, people don't lose the fact, it is precious metals, and it's physically mostly gold and silver with a little bit of platinum and a little bit of palladium. So as gold continues to rise, PMC ounce will benefit. As silver outperforms, the PMC ounce will capture that. And platinum and palladium trade on for different reasons, but they will probably and should continue to perform. Because as the dollar devalues, which is why gold goes up, real rare assets and needed assets like platinum and palladium, which are used in industrial processes, will also go up. So yes, I still think the PMC ounce is a good, logically diversified position. Another one here, how easy is it to sell gold and silver? very easy, right? As I said, we mentioned before, it's completely liquid. And so you can call and buy or sell, in the same day. There is no delay. It's not like a type of, it's not like a hedge fund or, some sort of private placement. It's actually more liquid than stocks because technically precious metals, not technically they trade 24 hours a day. So there's really nothing more liquid than it. So a couple more questions. Where's my prediction for the PMC ounce? We addressed that. Is there an option to borrow using PMC ounce as collateral? No, we do not leverage. We do not. You can't buy through us precious metals on margin. Margin is definitely in the world of that's really for options and derivatives, which isn't physical metals ownership. So and no, we don't lend money, to buy on margin. So, okay, I know you want to wrap up. I just want to say that we'd be happy at Neptune to answer any questions you may have. You can call us and just ask to speak with a specialist. They'll put you through to one of our traders. You can also email us at info@neptuneglobal.com. You can visit our website, neptuneglobal.com, and submit a question there. Also, there's a lot you can learn about us there. All live market pricing are published. Spot prices are published, and that's followed then by, you can go to the bullion exchange and see what all the different products are priced at. So again, Camaplan is in the unique position as being a self-directed IRA administrator that is also can be custodian for the PMC ounce and the gold and silver vault account. Of course, we deal in bars and coins also, but those products are particularly well suited for IRA investors. So with that said, William, if you want to just wrap up or.
Yeah, absolutely. Thanks, Chris. Thank you so much for taking the time and sharing your wealth of information to myself and our viewers today and future viewers who will be watching the recording. I'm sure we'll have a lot of views on this video. I want to thank everybody for attending. I hope everybody wrote down Chris's contact information just in case you had any questions that weren't answered. I'll say my contact information one more time. I'll also be reaching out to a select few registrants and attendees to see if they had any questions about self-directed IRAs or even a one-on-one consultation. You can either reach me at wmucker@camaplan.com or reach our office at 215-283-2868. And one more time, I just want to thank everybody, Chris and all the attendees, and I hope everybody has a great day.
Thank you.